The Fed has delivered a supersized cut, and EM central bankers, like the Reserve Bank, will now have to face up to a 4.4% Fed funds rate by year end and as low as 3.4% by end of 2025. So will dollars rush to emerging markets because you earn less on US bonds? Will the Reserve Bank have to cut rates to avert a rupee depreciation? The FOMC has also, remember, lowered the US growth forecast just marginally from 2.1 to 2% for the current year. It has upped the unemployment forecast to 4.4% from 4%. This will mean a slowdown in global growth, or will it? Then which stocks would be best bets for an Indian investor? For a 360-degree perspective on the Indian and global markets and macros, I have with me the JPMorgan Brain Trust. Sajjid, Chinoy, the Economist, Sanjay Mookim, the head of Equities and Research, and Kaustubh Kulkarni, the head of country head in India. They've all been kind enough to come over ahead of their all-important investor conference on Monday. And so here's trying to get everything that foreign investors think about us. But first, Sajjid, first things first, the Fed cut. What does this mean? Now is a Reserve Bank rate cut imminent in 2024?
So first, let's talk about the Fed cut. And our US team had called for a 50 basis point cut, so this is not a surprise. I think what matters more than the quantum of whether this was 25 or 50 is why is the Fed cutting? Is the Fed cutting because the US is on the cusp of a recession? And our answer is no. In fact, if you look at the Fed Atlanta's nowcast, growth in the third quarter in the US is tracking 3%. The consumer is extremely solid. So the Fed moved because the balance of risk has now changed. They're much more comfortable that inflation is heading towards 2%, and they're a little bit concerned that the labor market has begun to soften. If you look at their own Taylor rule, right, about where rates should be, given this mix of unemployment and inflation, it should be at 3%, 3.5%. So there was this 250 basis point level shift that they had to undertake, and that's the way to understand this 50 basis point cut, that we may see more of it if the labor market slows in the coming months. Don't rule out another 50 in November if the labor market slows. But the point is that rates are now much above where conditions on the ground in terms of growth, inflation, the labor market are. The important part is the US is not slipping into recession just as yet. So they're cutting, in a sense, from a position of strength. This was a happy cut because inflation is coming off faster than they actually thought. What does this mean for emerging market central banks, Latha? There are going to be a lot of idiosyncratic factors. We should not rush to
India.
First, India. Well, let me just lay the backdrop by saying Brazil hiked yesterday by 25. Bank Indonesia cut by 25 even before the Fed. So a lot of idiosyncratic factors will matter for emerging markets. I think for the RBI, again, the news is incrementally positive, that despite a slight upside surprise to CPI last month, despite the fact that September CPI could bounce back to 4.8 or 4.9, there's more conviction now with every passing week and every passing month that food inflation is going to gap down. We've had a strong monsoon. It looks like a good sowing season. Global
so
food
for
prices
domestic
are benign.
reasons, you're saying?
So, but I do think the RBI will want to see a little bit more data. So we actually think in October they'll still hold their gunpowder. They'll want a little bit more conviction that yes, food inflation after 3 years of being sticky is finally going down. And as the governor keeps saying, it's not about being at 4% for a month. It's about durably seeing 4% for the next few quarters. But this does, I'll end by saying, if the Fed cutting this year increases the odds of a soft landing in the US, that's a very good global environment for risk assets and emerging markets in 2025.
Our viewers are dying to hear what it does to Indian stocks. But very quickly, would you believe that there is still a global cloud on Indian growth? The domestic factors are pro-growth, yes, but there is a global slowdown?
No question that, yes, the US is holding up, but look at the other parts of the world. There's been a lot of US exceptionalism. Europe has been soft. China continues to soften. So global growth is going to soften. And as we saw in the latest trade report, we won't get the same tailwind from exports that we have been getting over much of the last 2 years.
Okay. Well, with that, let's come to the area where we are, immediately interested in stocks. Sanjay, I read your report on how India is in a late cycle of the business cycle. First, just explain to us before I bring the Fed in.
Well, look, we've seen for the last few years in India very strong stimulus support, very strong economic growth, upgrades which are rare in India to earnings estimates and companies beating forecasts. that seems to have faded away, Latha, right? And in
The first quarter saw downgrades.
That's right. And a significant number of downgrades, which actually is very rare for 1Q. We normally see downgrades in 3Q and 4Q towards the end of the year, but we actually seen misses and downgrades in 1Q. We've also seen the downgrades to the GDP number, for example, as well. And that's one of the reasons we are talking about slightly late cycle dynamics in equity markets. Of course, we've stopped talking about valuations because, you know, that signal has been flashing red for 2 years now. But in terms of growth, in terms of outcomes of companies, earnings momentum also, it does appear that we are more than through a significant upcycle in the equities market at least.
Okay, so therefore is it don't avoid equities or is it some kind of equities?
Well, that's a bit
Like,
hard.
what would your preferences?
Right. So it's difficult to say avoid equities entirely because, of course, let's say if you're a local investor, Latha, and this is one of the challenges.
Where else will I put my money?
Exactly. Right. With the tax incentives that we have in the economy, equities still appear relatively decent on an expected return basis, right? And it's difficult, therefore, to say you sell everything and leave the market. It's the only thing that we argue is that a lot of corners of the market are propped up principally on liquidity. And when things turn, it is that liquidity that presents a risk. See, the one thing that people forget at the top of every bubble, we don't know when it will be, is liquidity, right? Bubbles burst because of liquidity issues. And therefore, our advice to investors is that in all of your participation, be cognizant of quality risks, right? Do not compromise on having
Quality.
Exactly, right? You know, we
So
can't.
you're never left holding a lemon.
Exactly, because when the tide turns and you should not be unable to get out of your stock.
No, but what is a typical late cycle stock that does well? If you're in the late cycle, obviously the big growth areas, consumption should not do well. What should do well?
Well, as of now, we are overweight consumption, Latha, and this is because we've
Both durables and FMCG?
more durables for more FMCG, I beg your pardon, for now. And this is because we expect the K-shaped recovery that we've had post-COVID to converge a little bit. We're starting to see a little bit of signs of it. It's still very early to kind of convincingly argue it, but there is hope that this might happen. So we are actually overweight the staple stocks.
And what else?
We like real estate, for example. We think the momentum, again, going back to the argument, where else will you put your money? The equity market benefits from it. The real estate market should also benefit from it. We are overweight healthcare. We also like, so we are not very keen, let's say, on the IT and material space as of now.
No, I would assume healthcare is a late cycle preference. It's a defensive.
It is.
I want to come back on whether the K is converging at even slightly. But before that, Kaustubh, the big point is that FIIs are not flowing into Indian equities as much as they're even flowing into Indian debt. When you look at the data around, quite a few GEM funds are, not up to the weight they should be, rather underweight India's, weightage in, for instance, MSCI. What's your sense about how they will behave now? Do you expect that now, with the dollar also weakening, will there be a FOMO and they rush in?
I think it's true that relative to the MSCI weightage that India has, FI ownership is still, at least depending on the day, 2 to 3% lower than what it should be. But a big reason for that is the weights for India have increased meaningfully compared to where they were 3 years ago. Two, Indian market and FI, a number of the largest FIIs understanding in the Indian market was reasonably limited to around 75 to 100 of the larger liquid stocks, as Sanjay mentioned. Whereas, as we know in India in the last 3 to 4 years in particular, the breadth of the market and number of companies which have created excess returns is way, way larger than just the 75 or 100 companies. FIIs therefore have to go through their own recalibration and understanding of the market in India. Once they are able to do that, and that's where we are seeing so much more interest from FIIs to understand exactly what's happening. Because of the change in weightage, they have to do more work. But equally, they have to do a lot more work in terms of the complexity and the breadth of the stocks that they have to start covering. We think they are doing active work, and hopefully, I think, therefore, the money will follow once they finish the work.
What about large banks? I mean, Sajjid is saying that if not a rate cut in October, it's somewhere there in the horizon. What does that do to your view of financials?
Well, I think most foreign investors, of course, have a decent exposure to financials already, right? And this is a legacy exposure. It's a macro view, take an economy to just go buy a set of banks in the country. That's how it's played out for many years now. And what we're seeing, of course, is banks are best placed on the valuation filter, Latha, but on the growth momentum, naturally, there has been a significant slowdown, right? In the terms of the YOY growth that you got in 22 and 23, the growth we are now getting out of banks is much more meager. So the debate you have in the investment sort of ranking, this looks great on valuation, but the growth number is perhaps no longer as exciting as it used to be. Now, our pushback is, look, relative to growth valuation or a PEG ratio.
You may prefer NBFC in that case, no?
Yes, but NBFCs can be far more cyclical.
Okay.
Right. You have to take a cycle view, sector view, rate view, for example.
Fair enough. I have more questions on the rate view as well and what it does to bank margins. As well, this very interesting point to make about whether the K is not widening, but probably lessening, and more important, dollar. Dollar and dollar rupee, where is it headed? All those questions to the JPM Brain Trust after the break. Welcome back. We are in conversation with the JPM Brain Trust, Sajjid, Chinoy, Sanjay, Mookim and Kaustubh Kulkarni, ahead of their all-important investor conference, which kicks off on Monday. Gentlemen, thank you very much for your time again and waiting on. Sajjid, the currency. Now, if a 3.4 is the end rate of the Fed funds rate by 25, and 24 itself it will be 4.4. The dollar is moving towards 100.
Yes.
Do you does your US team pencil in a fairly much cheaper dollar below 100? Yeah. And what happens to the rupee? Already appreciated from 84 to, closer to 83.60.
Again, it matters why the Fed is cutting. If the US does not go into a recession and there's a gradual slowdown and the Fed is cutting and this is a soft landing, the dollar will weaken, right? And in that environment, all emerging market currencies will strengthen. But if the US slips into recession, historically that's been a risk-off event. Yeah. And then the dollar strengthens. So it really matters why the Fed is cutting and what the US growth backdrop is. In the case of the rupee, I think we should be realistic here. Don't expect too much rupee appreciation. I think the central bank has correctly ensured that the trade-weighted real effective exchange rate has been broadly stable. China has massive excess capacity that's flooding into all countries, including India. There are risks that if China continues to disappoint, the CNY will depreciate. The last thing India wants to do is give China a further cost advantage by letting the rupee strengthen. So if exports are our focus, if the focus is to reduce imports from China, we don't want a stronger rupee.
Absolutely.
Right? And so in a world where the dollar is weakening and other emerging markets are strengthening a lot, if the RBI correctly buys dollars and does not let the rupee strengthen, in trade-weighted terms, the rupee is weakening, and that's good for competitiveness. Yes. One last thing I'll say is our reserves, people keep asking, why is the RBI hoarding so many reserves? Our reserves are not earned reserves like current account surplus countries. Our reserves are borrowed reserves through capital inflows. For every dollar the RBI has, there's a dollar sitting in the economy, a liability in the economy which can unwind. So I think the strategy has worked so far. Expect if there's a large BOP surplus, the RBI will buy these dollars and any rupee appreciation will be very, very modest.
Okay, very modest.
Very modest.
But, just a word more on growth. As it is, the trade deficit was, widening. In the last August number is not very flattering.
Yes.
So, do you think that exports are already finding resistance in global destinations?
I think
exports fell by 9.3%.
Yeah.
Not a small number.
I mean, the main reason why the trade deficit ballooned was gold imports.
Yeah, of course.
But you're right. I think the manufacturing goods cycle around the world is struggling, and India will not be immune to that. Part of it is because China has just got so much excess capacity. So we have to get used to the fact that, goods exports are going to slow. Service exports are holding up well. But we should not worry from a trade deficit perspective.
No, not trade deficit. I'm worried from a growth perspective.
No, you're at a very important concern that the combination of the goods cycle slowing and Chinese excess capacity means the goods sector around the world is struggling, and India will be no exception to that. So we'll have to hope for the fact that if X doesn't provide as much support, then C and I, right, consumption and investment, have to make up the difference.
Okay, you're getting into economics class now. Okay, Kaustubh, the more important thing is EMS company. Do you see this China Plus One continuing? We have seen fair amount of success in the EMS stocks, the Dixons, even the Tata Electronics. The South is seeing a burgeoning of investments. Will that continue?
Yes, for sure, Latha, because India has started the whole value chain on a very integrated basis on EMS side, and the amount of client dialogue that we are seeing from some of the most sophisticated product companies who want to get their products manufactured in India has substantially increased in the last 12 months. And that goes for EMS and also for some of the more high-end stuff like semiconductor. So when you have the whole prospect of a value chain being created and some very, very large and responsible companies are driving the investment and growth in India, obviously I think you're going to see very, very significant growth in the sector. So this sector therefore has a potential and prospect of creating very large number of jobs as well, just given the nature of work that goes on the EMS side. And hence it's in line with, let's say, what the government would also like to do is to start looking at and bringing sectors which have capability to put India as an important partner in the global value chain, but also contribute to substantial job growth in the country.
Okay. Sanjay, on that, are these attractive stocks?
Well, I wouldn't comment on...
I mean, see, don't go about the near term. I mean, you know you are considering we are in a late cycle now, but more generally for a longer term investor, I'm not asking you to name stocks, but is that a sector? There are two sectors which have burgeoned. This EMS sector, those making Apple iPhones and laptops and assembling, as well e-commerce. These two, how do you look at them?
Well, the growth potential for both of them should have huge runway, Latha, right? And like Kaustubh was saying, this is just a start. We need to create more back-ended, value additive component manufacturing in India. And this is very encouraging. It has multiple impacts. In fact, we extrapolated some PLFS data, Latha, and some of the data is very fascinating. That India has added about 5 million manufacturing jobs in the last, 10 million manufacturing jobs in the last 5 years. 90% of that has gone to women, right?
Oh, wow.
So you had the huge problem in India where labor force participation for females was very low. That's actually turned a corner. And this is, of course, extrapolated from a small sample PLFS data. But nevertheless, my argument is this is just a start.
There is a burgeoning of manufacturing jobs.
There is. And we are seeing it in many sort of verticals within that EMS, within manufacturing in general across the country. And there's a lot that can still be done.
Okay. This fascination for FMCG stocks, or rather your pro-FMCG stance, you see that continuing? I mean, are you convinced that there are that many jobs, multiplier effect, good monsoon, etc.?
I wouldn't go that far, right? And the reason, there's two reasons we've looked at FMCG a little bit favorably. And one is, of course, purely tactically rotational. Because India, if you look at the behavior of stock markets, is a very mean reverting market. And because of the flow of liquidity, investors are always on the lookout for nice quality stocks that have underperformed for a while. And FMCG fit that bill very nicely, right? And then you have companies coming out and telling us on the margin really that things in rural India might be getting a little better. So to your question, I'm hesitating to give you a right answer. Are we seeing conviction that things are getting better at lower income consumption? Not yet. Okay. It's more of a hope trade. That's right.
Okay. Well, to be fair, we had Sunil D'Souza of Tata Consumer, and he said much the same. It's hope that it should get better. Yes. H2 should be much better than H1. But Sajjid, I want numbers. What are you expecting in October? Stance change? First rate cut, December?
We'd lean towards the first rate cut in December. The stance change in October is a little tricky. Financial conditions in India are very benign already. Like, look at stock market valuations, look at credit spreads, right? And so one risk the RBI runs is, even if you want to signal a cut in December and you change your stance, you'll get a further easing of financial conditions. So at some level, some EM central banks are stuck between a rock and a hard place where you have to sound hawkish until you actually switch for risk of making financial conditions even easier. So it's a very close call, but I think we're leaning towards the first cut in December, by which time you'll have a second quarter GDP number on November 30th, and more importantly, conviction that inflation is settling in the low 4 handles where we think it is for much of 2025. We haven't spoken about the fact that crude is 10% down at 73. Commodities are down. This is good for growth in terms of trade shock.
So what is your year-end inflation? Is it RBI's 4.5?
A little bit lower. So actually, our inflation forecast for this quarter is about 4%. For next quarter is 4.3%. So it's a little bit lower than the RBI's forecast. And I think once they make those downward revisions, we're getting closer to the rate cycle starting. The last thing I'll say is the trade-off for the RBI is to use rates for growth and inflation. But we have to be cognizant that financial exuberance doesn't run too far ahead. So you may need to see more macroprudential tightening to curb financial exuberance, even as you're cutting rates to address growth and inflation.
Okay. Actually, I was going to ask you that because the Reserve Bank would be worried about, possible froth in the economy. But before I come to the one number which I'm going to ask you, how would you look at financials in the context of rate cuts? And as it is, we are seeing, the market yields go down because of the bond inflow. 6.75 is here. So, and most of the loans are benchmarked to repo rate and T-bills.
Yes.
But deposits are not falling. So why would you be, are you positive on banks, non-banks?
Look, that there will be pressure on margins is without doubt, right? It's the ability of which segment of which financial can reduce that impact or mitigate that impact the best, right?
Or counter it with growth?
Counter it with growth, we'll see. But ultimately for growth, you need the raw material for growth, which is scarce at the moment, right? So it's a question of time where the entire system has to go back down or track the level of raw material available in the financial system.
So NBFCs would do better then?
Technically, yes, historically. But we must also remember that they are not direct deposit taking, right? So they have a disadvantage.
So their
structurally.
cost of raw material also goes up.
Exactly, right? So it's in this sort of setup, the deposit franchises, the PSU banks who are flush with liquidity, at least relative to others, look a little bit better, to be honest. But we do like some segment-wise NBFCs where we see the underlying business demand being strong enough to mitigate it. So you have to be a little bit nuanced with the view that everybody's margins is coming under pressure.
Okay, well, the number question first to him and then to you. Do you expect, Kaustubh, that the FII flows, just gets unblocked next year? People wait and then go overweight on India, or at least equal weight on India. So what would your forecast be of FII flows next year into equities, next 12 months?
I think there are two key themes that are driving the forecast for FII flows. One is, of course,
more than last 12 months?
More than last 12 months.
Okay, yeah. And substantially more.
And maybe at least 10-20% more, just because of the quality of supply that is going to come to the market. So I think we always need to look at FII flows in terms of capital market activity. FII flows is not only chasing secondary market purchases. Indian capital market, just to give you some sense, Latha, in 2020, the peak for global equity capital market volumes was in 2021 for all markets. India is the only market where I think so far we have almost raised $45 billion of equity through primary and secondary. By the time we are completing this year, we will get to $55 to $60 billion of total equity raised in the market, which is 40% higher than our 2021 level. And everywhere in the world, all other markets are 20 to 40% lower. Oh. So when you have this amount of volume of activity, then it is just not logical or possible that FIIs will not be very, very closely tracking. And we at least don't see any reason or clouds on the horizon why this momentum that I think we have created is going to slow down getting into 2025.
Just one word, are there more investors queuing up for your investor conference this time?
Yes, so I think
how many more?
This year we have about 1,000 people attending our conference.
Okay.
The number of investors, and we stopped registrations because we couldn't accommodate physically, I think, the requests we were getting. But we're about 35% higher in terms of number of equity investors who are coming up. And more importantly, a very good mix between Asia, Europe, US, and of course, India. So we are getting, hopefully, I think, what is this telling? I think it's just telling that investors also are deeply caring about what's happening. And therefore, if they get a good platform like us, they are keen to participate.
The most important question. Therefore, what's the kind of equity gains, not just Nifty, generally for the investor in 12 months, in 24 months?
We are relatively cautious on that front because the Nifty is close to the upper end of our forecast range for this year. And this, of course, you struggle to argue that, returns will be generated only on multiples, right? You need to see earnings growth. For FY25, the base case consensus is about 12%, but in the first quarter, we've got sub 5%,
yes.
Right? So there is a little bit of a tone of caution we're using, and we believe that there needs to be a healthy consolidation or maybe, let's say, a correction even before we start to talk of further strong returns.
So not in the next 12 months, but the next 24 months are glorious.
Yes. So look, ultimately, equities are relative growth instruments, right? If India's growth sustains, then returns will come. It's as straight as that.
This is an unfinished conversation. We'll catch up. But that's the optimistic story coming in from JPMorgan, we are going to see a lot of foreign investments coming in. Yes, growth will slow a bit because we are in the mature part of the cycle before it picks up again with both government capex and private capex kicking in. That's it on this edition of the JPM Brains Trust. Thanks for watching.